Hello, this is Super Informed Radio, a UniSuper podcast. My name is Lyndon, and as usual, I am here to help bring you up to date with what's been going on in investment markets recently and also what might be on the horizon. Now, those of you who joined us for last month's podcast will remember that we recorded pretty soon after the start of the war in the Middle East, but before markets had opened for the month and had a chance to react to that news. So with me here in the studio to discuss what has been a very eventful month in financial markets is the person with all of the answers, our regular guest and friend, David Colosimo, UniSuper's head of fixed interest. Hi, David.
Hello, Lyndon. Good to be here.
Good to have you here. Now, David, it is the second year in a row that we are recording an April podcast on April Fool's Day. I'd normally be on high alert for any pranks from you, but given the moment we're living in, it kind of seems like anything could be possible at this point.
Anything is possible, but I'll try and stick to the facts, Lyndon.
Very good. That suits me just fine. In fact, as I look across at you, David, I feel like it's every month that I say, a lot has happened. But the last month is probably one of the most eventful that we have seen. The war with Iran really has dominated financial markets, hasn't it? And from what I understand, it hasn't really been that great for shares. Is that right?
Yeah, it's certainly been quite a rough month. Here in Australia, share markets down 8%. In the US, down 5%. In Australia's case, that's actually the largest monthly fall since 2022. If we look at other markets around the world, we've seen similar or even larger falls elsewhere. So Europe down at 8%, Japan and India down more than 11%. China, a bit better, but shares there were down 5.5%. So a lot of red across the screens. It has been, as you said, a rough month.
You say a lot of red across the screens, David. Was the red across every screen? Were there falls across every sector of the market?
It does really feel like it's pretty broad-based. The obvious exception was the energy sector. That benefits from the surge in oil prices. So Australia's energy sector up more than 18%. Woodside alone up 23%. Looking at the US, energy there up 10%. But other than that, gains for the month were really few and far between. Now, I often mention the market split into 11 different industry categories. In the US, you look past energy, and the other 10 of them fell very sharply, between 3% and 8%. There's a couple of names in technology and consumer staples that were up, but I'd note all of the Magnificent Seven names that we like to talk about a lot on this podcast, they were down between 1% and 12%. So they were down quite a lot. And even some names that you'd think would do well at a time of war. So think of defence contractors like Raytheon, Lockheed Martin. They were down 5% and 8% respectively. So a lot of losses in the US. In Australia, it wasn't quite as bad. We had two defensive sectors, utilities and consumer staples. They were up. Utilities up by a couple of percent. Origin, for example, up 2%. And the consumer staples, they were boosted by the supermarkets. So Coles, very defensive stock, was up nearly 7%, for example. Now in Australia, though, still 8 out of those 11 industry categories were lower. So IT, mining stocks, discretionary retail, they were the hardest hit.
Goodness, yeah, some large moves there for sure. Just in terms of the attack on Iran, David, now there was some talk that an attack might be coming, wasn't there? So if the market was anticipating something of that nature, why have we seen such large falls? Is it mainly about what's transpired since?
Yeah, you're right. If you look at the initial attack, that certainly wasn't a surprise, but a lot of the outcomes since then have been. I think the unstated prevailing assumption around the market was that President Trump would escalate, he'd declare victory very quickly, and then he'd move on. So the shock was not the war, but how quickly Trump lost control of the narrative around it. Now, the US and Israel hit Iranian targets with precision and seemingly at will very quickly, so no surprise there again. But then Iran's ability to maintain control of the Strait of Hormuz for such a long time, that has been quite a big surprise. So that cuts out about 20% of the world's oil and gas trade. A short period of closure wouldn't have been so damaging, but now that it's gone on for quite some time, it is becoming a bigger problem. Iran's decision and ability to hit strategic targets in the region, including neighbouring countries' energy infrastructure, using very low-cost drones. That was also, I think, somewhat of a surprise. So The Las Rafan gas field, for example, in Qatar, that's now going to be out of action for between 3 and 5 years. I don't think the market was anticipating that sort of damage. And finally, I think it's really well understood that the Gulf region is important in oil and gas production. But I think many, including myself actually, were unaware just how significant the region is in the production of a range of other commodities. Helium, for example, which is used in semiconductor manufacturing. And probably even more importantly, urea and ammonia, which are used in fertiliser. So not only is the world short of energy now, but also a key input into agriculture. So that could really boost food prices as well.
Have you been surprised by any market moves, David, like the impact on energy prices?
Well, the volatility of oil prices has been quite shocking. Even in a single day, oil traded between $81 to $120 and then almost back again. But the size of the move, probably not a surprise. In fact, if you had told me this time last month that the Strait of Hormuz would be closed for all of March, I actually would have guessed oil prices would have been a lot higher than they are today. So if anything, the surprise is how well behaved the oil price has been despite all that's happened. If you're talking about financial markets, I think the two biggest surprises for me have been the reaction of bond yields and gold. So if you look through history, big oil price shocks are generally accompanied by global recessions. Now, given the size of this disruption, a global recession is not assured, but it's certainly a real possibility. So you might expect in that environment bond yields would actually probably fall. But instead, markets have been more focused on the risk of inflation from higher oil prices. And so bond yields have actually surged between 0.3 and 0.4% across the world over the month. And gold's probably even the bigger surprise. It's often touted as a big safe haven asset, so during times of market turbulence that it will actually be up. But it was down nearly 14% in March.
Yeah, and we've talked previously about gold, David, and it being a store of value and whatnot. Why has it been so weak?
Well, in markets there's been a lot of talk about the impact of higher interest rates, the fact that a lot of central banks have stopped buying it. But I really think it just comes down to the fact that it had run really hard over the last year or so. A lot of investors were crowded into that trade. And so when the war started, people have a tendency to reduce risk across the board. And I think you saw a lot of winding back of those positions. In the first few weeks of the war, we did see a lot of the winners from January and February fall the most. And I think Korean shares are the best example. So last month, they actually mentioned they surged 20% in February alone. But then war broke out and they've actually fallen 20% in March. Probably tells you that it was just a really crowded trade being unwound.
David, you mentioned at the beginning that a lot of other countries have had even bigger share market falls than the US has had. Why was that?
Well, I think a big part of it is the markets differentiating between winners and losers from higher oil prices. Now, over the last decade, the US has become a big energy exporter. So yes, consumers will suffer with higher prices, but the energy companies themselves benefit. And so initially, it's certainly one of the most resilient share markets. If you look at Europe and countries like Japan and India, they are energy importers, so they're seen as the biggest losers. And I think there's also a price element here as well. We often talk about oil prices as if there's one global price across the globe. But in reality, it's a suite of prices depending on geography, depending on the grade of oil, whether you're talking about crude product or refined product. Now, usually all those prices move together, but the prices of oil and gas have risen a lot more in Europe than in the US. So they are more dependent on energy imports, but they're also coping with a bigger price shock.
David, with everything going on at the moment, our listeners probably going to be wanting to know, have we seen the worst of it? Am I hearing a prediction in there somewhere?
Nice
Maybe?
try, Lyndon. I'm not about predictions today.
Fair enough.
But what I would say is that the market, it is now priced for a meaningful hit to growth and weaker earnings, but I don't think it's priced for recession. So there's plenty of room for even more adverse scenarios to play out. It does take time for oil shortages to make their way through the system. If you've got a fall in production by 10 to 15%, you either have to run down strategic reserves, which you can only do for so long, or you have to start rationing supply. So this is more than just price increases. This is about quantity. Will there be enough petrol, enough diesel, enough jet fuel to keep the economy ticking along? And if not, how do we decide who misses out? How much impact does that have on economic growth? Australia is particularly vulnerable here because we don't have a lot of inventory to begin with. We're very dependent on Middle Eastern oil that comes via refineries in Asia. So not only are we dependent on the oil coming through the strait, but then we depend on the refiners agreeing to send it to us when they might be facing shortages themselves. So Australia are as much at risk as any country.
Okay, let's look forward to the month ahead, David. Now, I'm assuming that all eyes will still be on Iran. What are the key things, though, that you're going to be watching out for?
Well, first and foremost, the big question is whether and when the Strait of Hormuz will be reopened to oil tanker traffic. Noting that even when that happens, it will take some time for production that has been shut down to reach full capacity. So that's a couple of months. And in some cases, some years for those facilities that have been badly damaged. Now, there are some indications that President Trump is thinking about winding down hostilities, regardless of the status of the Strait of Hormuz. But the one thing that has been consistent in the past month has actually been the inconsistency in his messaging. So that's actually created a lot of daily volatility. We've had a lot of conflicting headlines. Sometimes it actually feels like that's intentional because they're trying to keep markets under control. So regardless of what he says, it does remain to be seen what happens there. Now, less obviously, but one we also need to consider, is whether military activity moves to the Red Sea. Now, of the 15 to 20 million barrels a day that haven't been able to pass through the strait, Saudi Arabia has managed to divert an additional 6 million barrels a day via a pipeline to the Yanbu port in the Red Sea. Now, this has helped limit the supply losses, but shipping through the Red Sea is very vulnerable to attack from Iranian-aligned Houthis in Yemen. And so if that happens, that would make things worse again. And aside from that, we also need to keep an eye on economic data to see how the economy is coping with these price increases and supply shortages.
And, you talk about data there, David. What sort of data are we talking about?
Well, data that answers questions like are consumers cutting back on other spending to cover higher petrol bills? How are businesses coping with increased costs? Are they passing them on? And therefore, how is inflation going? Obviously, we know energy prices will be higher, but will food prices spike because of those fertiliser issues? Will there be second round price increases?
Yeah. Okay, cool. We are running out of time, David, and we haven't yet had a chance to talk about the central banks. Over to you. What's going on?
Well, we've been talking about surprises a lot in this podcast, and I suppose another one of them for me was the central bank response has been a bit surprising as well. So really across the developed world, central bank communications have been hawkish. When I say hawkish, I mean that they've been talking a lot about hiking rates in response to the threat of inflation. They really seem less concerned about the risks to growth at this point, and market pricing reflects that. So last month, markets expected more rate cuts in Europe and the UK, for example, but now they're expecting rate hikes.
And for Australia and the US, David?
Well, the next Fed meeting is on April 29th. This will be Jerome Powell's last meeting as Fed chair. The market's expecting no change here and still leaning towards cuts later in the year when the next Fed chair takes control. Here in Australia, we have now seen 2 rate hikes from the RBA. The market is actually priced for another 2 hikes still coming. And the next one of those at the next meeting on May 5th.
All right, David, last call on anything else you're looking out for over the next few weeks?
Well, it does feel like it comes around very quickly. We do have US quarterly reporting season starting again, the banks report in a few weeks, the big tech companies towards the end of April.
Well, we will hear all about that next month. But for now, that's all we have time for. Thank you so much again for joining us. And yeah, look forward to catching up with you next month. Who knows where we'll be by then?
Who knows, Lyndon? See you then.
See you then. And that wraps up this episode. Thank you for listening. Don't miss future episodes of this podcast. You can subscribe to us wherever you get your podcasts, subscribe to the UniSuper YouTube channel, or check unisuper.com.au/podcasts at the start of each month. Now, our Chief Investment Officer, John Pearce, he's going to be releasing his next investment update video later this month, so please look out for that. It'll be on our website and our YouTube channel when it's ready. We are UniSuper, the place where bright minds and passionate people strive to think great and create a future worth retiring for. If you'd like to learn more about our investments, visit unisuper.com.au. Thank you for listening, stay safe, and we'll see you next time. This podcast is general in nature, and it doesn't take into account your financial situation, needs, or objectives. So before you make any decisions about your super, we recommend that you seek financial advice first. Also, make sure you've had a read of the product disclosure statement and the target market determination that's relevant to you. They are all available on our website. It goes without saying that the past performance of any investment options that we talk about isn't indicative of their future performance, and it's worth noting as well that just by talking about certain companies, we aren't endorsing them for you to include in your own portfolio. Also, probably not a bad idea to mention that certain information contained in this podcast may include forward-looking statements, and we obviously don't guarantee that those statements will eventuate. And lastly, UniSuper has no obligation to provide updates or changes to the information in this podcast.